So let's talk about this new obsession sweeping through the entire finance YouTube scene. It's everywhere, and honestly, if this genre was on Hub, I'm pretty sure it'll be trending right now. So what's all these doom and gloom, market crash, and bubble narrative going on about? Let's try to break it down in this video. But before that, I think just this past weekend, there's this very interesting monster called DeepSeek, and it's taking over the entire financial world by a storm. I think it's trending on both YouTube and also on X.com. And very interestingly, as Zero Edge has put out this tweet, DeepSeek better not be the real deal because it's in direct rivalry of this very strong Magnificent Seven run over the past, 5 to 10 years. But before that, for those of you who are unaware, what exactly is DeepSeek? So, and I quote from a Wired article. So, DeepSeek has embraced open source methods, pooling collective expertise and fostering collaborative innovation. So, this approach not only mitigates resource constraint, but also accelerates the development of cutting edge technology. If I can summarize, it's the Taobao version of OpenAI or ChatGPT. So, it's basically China's answer to all the export controls on AI chips, and more importantly, how they're able to develop cheaper, faster, and better AI solutions. And long story short, they're able to bring down the cost. But to ground you back to the topic at hand, we are trying to investigate whether this recent Magnificent Seven-led US rally is going to be sustainable and what kind of potential challenges that we see ahead from here. And some are even calling this the potential Black Swan event. And CNBC has just released the video on DeepSeek threatening US dominance 1 day ago and has garnered more than 1 million views. And right now, as we're speaking, DeepSeek is now the 6th most downloaded iPhone apps in the US across all category, ahead of Google or even Instagram. And you DeepSeek this, DeepSeek that, why don't you seek out, this was not supposed to be in the presentation slide. So let's go back down to the definition of what a Black Swan means. So a Black Swan event refers to a rare, unpredictable, and high impactful event that significantly disrupts financial markets or the economy. So these events are often widespread consequences and are typically only rationalized in hindsight. And there are 3 key terminologies here that needs to be fulfilled in order for it to be called the Black Swan. It needs to be unpredictable, means that it's unexpected and not easily foreseen. It's high impact, means that it caused significant financial, economic, or societal disruption. And its hindsight bias means that after the event occurred, people often try to explain it as if it could be predicted. So just by judging on the terminology of how you explain and define Black Swan, you don't have to bother wasting your time there because clearly you could not foresee this event happening. And investors can continue their argument whether DeepSeek is going to be the straw that's going to break the camel's back, but that's not my focus, or at least it's not the emphasis of this video. Instead, I would like to pull myself back, look at the broader picture of the entire US stock market and see how fragile, or in this case, how resilient it is to some of these claims about an impending market crash. So as you can see here, let's try to take stock at where we are currently at in terms of the general market valuations. And if you to look at some of these most interesting time points that they've decided to bookmark or extract here, it's the time before the 2000 dot-com crash, before the 2008 financial crisis, before the COVID crash, and before the 2022 inflation or interest rate crisis here. So I just would like to point your attention towards ignoring the index level because clearly the number itself don't really make any sense. So let's look at it more from a PE ratio point of view. So if you just look at the PE ratios on a standalone basis, comparing the 5 time periods being bookmarked out here at 21.5 times forward PE at the current, end of 2024, start of 2025 kind of period, we are clearly on the higher side. So you can see that based on the 4 time periods before the so-called market crash, only the dot-com period was even higher than now at 25.2 times. 21.5 times, we are higher than the GFC, we are higher than the COVID crash, and we are higher than the inflation interest rate bear market. However, now, if we were to put in the idea of a dividend yield, and at a 1.3% dividend yield, we are kind of the lowest at all 5 time periods. And just so you get the context, the lower the dividend yield, the higher the valuation, because investors are willing to pay a premium in terms of driving up the valuations or share price of that particular instrument. Higher share price, if all things stay consistent, same dividend payout, the lower the yield. However, just looking at the dividend yield alone on an absolute level is not enough, because as an investor, we tend to have access to the entire range of different financial products in the capital markets. So we want to kind of take reference from other products in the investable universe, so we know that whether we're getting a good deal or not. And in this case, if to compare just the dividend yield with the so-called risk-free rate, it tells a much more terrifying story. And if I were to ignore the dot-com and the great financial crisis, and just comparing it to the 2020 COVID crash and the 2022 inflation crisis, you can see that the dividend yield and the 10-year treasury, they are probably in lockstep. Yes, there is still some sort of a premium or discount, but I think it's quite tight in terms of their spread. But comparing it to today's market environment, the delta, or at least the difference here, is starting to climb quite dangerously. And looking back at the previous crisis, you can see that the difference between the yield and the treasury rate, it's also at an alarming difference. And just to square away the idea of why people are willing to pay such a premium for the S&P 500, firstly, let's not forget that they are one of the prime investment instruments out there that is able to yield a pretty high return on a historical basis. Secondly, because everybody is expecting the portfolio of companies in the S&P 500 to continue to grow. So this dividend yield is not a fixed one, it's actually a growing one. Touch wood, of course, hopefully nothing happens and earnings of this portfolio of companies don't get severely impacted. On the flip side, comparing it to risk-free 10-year treasuries, they don't grow. However, I think there is a very stark difference here on 2 points. Firstly, equity prices, which in this case S&P 500, deserve to trade at a premium, or in this case, willing to accept a lower yield because of the expected performance. But the second larger question is, how much is too much of a premium? So that's really where everybody is trying to guess. And we let demand and supply of the market try to guide our investment decisions. And clearly, at the current point in time, at least at end 2024, at a forward PE of 21.5 times, a dividend yield of 1.3% compared to risk-free of 4.6%, it's clear why people are sounding the alarm bells and why bears are coming out of their hibernation. But one important nuance here to take into account when you're doing such analysis is the inflation environment. And I think the bond market is currently throwing a tantrum, allowing for the yield to continue spiking upwards because they're afraid of inflation coming back. And if inflation comes back strongly again, it's a catastrophe for bondholders because they are promised a nominal sum, meaning to say the percentage do not account for inflation. But on the flip side, if you're investing into equities, and equities by default are invested into companies are able to raise prices, they're able to help you kind of combat inflation in a way. That's why there might be this inflation picture playing in the background as well, just to take note there. But that's it. I think focusing squarely in terms of some of this popular valuation metric when identifying the S&P 500, such as your PE ratio, your CAPE ratio, your cyclical adjusted PE, dividend yield, price to book, price to cash flow, comparing it to their 30-year average, actually on all indicators, they are signaling that the S&P 500 is probably overvalued. And here's the most convincing bearish argument. They basically plotted the S&P 500 forward PE ratio and their subsequent 10-year annualized total return. And at current levels, as denoted by this grey bar here, we are clearly not showing a very pretty picture. And you can observe that there's a very strong relationship between starting valuations and their subsequent annualized 10-year return. So the lower the forward PE ratio of the S&P 500, the higher the annualized total returns moving forward. So higher starting valuations consistently lead to lower returns and vice versa. And today's PE ratio is clearly well into the top decile of observations. And people who bought S&P in line with today's multiple of 22, they earned a 10-year return of between plus 2% and minus 2% annualized return. And if you do zoom into the lower time frame, which is comparing it to the subsequent 1-year and 5-year annualized return, you get a much more noisy and haphazard kind of relationship. Looking at the same 21.5 times forward PE ratio, you can see that the next 1-year return can be anybody's guess. It could be the high 20, 30, 40% returns or even a negative 20 to 40%. However, when you stretch it out to the 5-year annualized return, you can see a much stronger correlation. But fortunately or unfortunately, at least at 22 times, you still see some sort of a positive return in the next 5 years or so. And the number really goes into the negative territory only when the forward PE of the S&P 500 goes to above 23 times. But if you do piece everything together, piecing the 10-year annualized return of plus 2 to negative 2% profile and the next 1 year with higher probability of having a negative return and the next 5 years of getting close to 0% annualized, it's definitely a pessimistic view for investors that are interested into investing in today's market climate. So the natural question would then be, what does a 22 times forward PE mean? So it's one of the highest level that we have seen in the past 20 odd years. And you might think that earning 2% a year isn't terrible because that's the distribution of outcome. But here's the catch. Either the stock price stays flat for years while companies grow their earnings and eventually making valuations more reasonable, or stock prices drop sharply over a year or two, leading to big short-term losses. So that's really the big question on many investors' minds today. Are we going to see that huge short-term drawdown, and when would that happen? And it shouldn't come as a surprise that the return on an investment is significantly a function of the price paid for it. And the typical advice that you'll get from such videos is that time in the market is more important than timing the market, or you should just adopt a dollar cost averaging approach. If the market goes up, you continue buying. If the market comes down, you buy even more. That's basically general consensus. So I believe there's a reason why this quote-unquote advice are being propagated, because they've been tested through time and they're traditionally sound advice. But for those of you who have watched up until this point, I think my word of caution, or at least a nuance that I want to spin here, is that your typical personal finance or investment advisory advice becomes even more important as the market continues to climb. And I do understand that investors are getting excited, especially after all these 20% back-to-back returns, and thinking that, hey, my investment skill set is great, I'm at the top of the world, a lot of my picks have turned out well and I've benefited tremendously from this huge market rally. But I think just to air some sort of a caution here and to just bring you back down to earth, make sure that you have a long enough time horizon to ride out all this volatility, at least 5 to 10 years. And some of you might be thinking that, oh, if I've put my emergency cash or put some of my renovation funds for my house in the next 2 to 3 years into the stock market, in the past 2 years, I could have made a killing. But I think it's really a timely reminder that you should not invest any funds that you need in the short to medium term, because markets can really be volatile and you can't predict how Mr. Market will react. Secondly, please reassess your portfolio regularly. So it could be stress testing or rebalancing, but I think the bigger takeaway here is to constantly keep a pulse on your portfolio. And thirdly is to keep your emotions in check, and please do not over leverage just because you did extremely well in the last 2 years or so. So if you ask me, here's what I have to say. If you're under 40 with more than 20 years in terms of your investing time horizon, just stay on the ride. So if you're allocating capital yourself, for example, you're a stock picker, then I think your picks should generally be undervalued. And it doesn't really matter if the general market is quote-unquote overvalued. And if you're in the third camp and you don't know what you're doing, then it doesn't matter if the general market is overvalued. And here's 3 key takeaways from Howard Marks on his recent memo. So a bubble isn't about soaring prices. It's a mindset fueled by irrational exuberance, FOMO, which is fear of missing out, and the belief that there's no price too high. So while valuations can hint at bubbles, the real tell is when people stop questioning the price and get swept up in a mania of unchecked optimism. So investor psychology drives markets more than events. It's not about what's happening in the economy or corporations, but how people perceive those events. And every bubble starts with a grain of truth. Bubbles often stem from genuine innovations or trends, like the internet in the late 90s. But when expectations become excessive and prices assume endless growth, the risk of sharp declines increases. Overpriced assets can crumble under negative surprises or new competition, reminding us that trees don't grow to the sky. Thirdly, today's market leaders face the challenge of persistence. Companies like Nvidia, with strong technology, scale, and profitability, are valued on the assumption they'll maintain dominance for decades to come and grow profits steadily. However, history shows that staying on top is hard. So as I've shared in my previous video, this is my portfolio for 2025. And the bottom line is, I'm actually not urgent with deploying my cash. And I've realized that I only shared my individual equity positions. And I didn't really show you on a portfolio basis how much cash I'm keeping. So I did a very quick and rough calculations in terms of how much cash I have left. And I can say that I'm roughly sitting at around 12 to 15% in terms of cash allocation. Is this too bullish or too bearish? I think it's really dependent on the investor. My portfolio, it's still very, very overweight China equities. And US, although I have skin in the game, the US undergoing any form of 20%, 30% correction is not the end of the world for me. So I actually do look forward to how the US market is going to play out in 2025. And I think it's really a tweak in terms of a mindset here, where if you're really investing for the long term and you want to accumulate great assets, you actually want the share price to come down. But the interesting thing is, investors always want their portfolio to break all-time highs and to see their investment just go to the moon. So here's just a few final thoughts. I think it'll be irresponsible to say that the market is currently super undervalued and you should take leverage and go all in. But I think regardless of the market condition, you should not take leverage. And I think as the late Charlie Munger puts it, there are 3 L's that will kill any man. Liquor, ladies, and leverage. So it is definitely expensive right now, but I'm not too sure if you can 100% ascertain that we're in bubble territory, i.e. we might not be at crazy euphoric state yet. So general investor sentiments are definitely on the high side, but it feels like it's an enclosed circle. Enclosed circle meaning those that are interested in investing, those that are interested in finance. A lot of people are expressing concerns about bubbles and the overvaluation. Anecdotally, however, I've not met my shoe shine boy story yet. Back in the Great Depression era, I think Wall Street bankers were getting their shoes shined by the roadside. And when the shoe shine boy is trying to advise you on what's the next great hot stock tip, you probably would know that the stock market is in bubble territory. So from my own perspective, I've not yet seen people outside the financial realm or financial sector, I'm talking about or dishing out the next great stock tip. So that's that. So this recent 2-year rally has been driven by incredible story and execution, and not just building sandcastles in the air. So they're backed by growth, profits, and they have a clear path for outlook ahead. And they're definitely grounded in numbers. And if you put 2 and 2 together, their valuations today could be warranted. And that said, even in an overvalued market, there are going to be opportunities. And if you're a stock picker, you don't believe in EMH, which is the efficient market hypothesis. So general valuations going up just means that your life is harder because opportunities are lesser known. But that said, it does not mean that there's no opportunities available in the market. Finally, you must know that what game you're playing. If you're ultimately a bottoms-up stock picker, then focus on companies' fundamentals and their individual valuations. And if you're really going to guide your decisions, meaning to say, if you think that the market is overvalued and then you go 100% into cash, then I think that's a very dangerous mindset. Notwithstanding the fact that if you don't find opportunities, you can let your cash position swell up or grow a little bit more to be more prudent in terms of your capital allocation. If not, I think you can just continue playing the game that you're on. And just a final quote here is that we have 2 kinds of forecasters here, those who don't know and those who don't know they don't know. Especially in this algorithm-driven world, please do take note of your own biases and don't be stuck in your own echo chamber. I do look at some of these videos and some of these sharings on X or whatever Reddit platform out there, and you really see people just treating this like a religion. Meaning to say, if they think that the US market is going to crash, they're always so excited and enthused about their point of view, saying that the US market is going to crash 50%, and they're expecting some sort of a doom and gloom scenario, and whether is it investing in gold or what other investment instruments out there, makes them form their biases and reject all other claims. I think as investors, we need to be both intellectually curious and intellectually honest. And I'll just end off with that comment. With that in mind, I'll see you in the next video, but more importantly, I'll see you guys on the moon. Goodbye.